Now we're going to take a look at the voltage meter. Before I do, check. Brian, that's a real microphone. Don't tell people it's not. So when we look at the voltage meter, we got feedback from you, and we've changed some of the naming to make it easier to understand. Today, we're seeing a negative reading on the market. Go back to the last video, it was neutral, meaning we were adding to certain positions that were in a good spot to buy, individual stocks. But now, we're in a negative, and we're going to explain what that means in the current activity section next for your portfolios.
So Jake, the voltage meter is definitely looking different than last week. What happened?
The biggest thing that happened is an inflation report came out yesterday. It was higher than expectation, and that pushed the market lower.
Yeah, we saw a pretty significant drop. And so we took action. And we ended up buying more inverse funds in many portfolios. So what that means is these are funds that will actually increase in price when the market goes down. So Jake, what does that mean for our outlook over the next several weeks and months?
Brian, it's important to understand that what we're doing right now with the inverse funds, that's our current outlook, and that's our current positioning. But from a longer term perspective or the strategic outlook, we still think the market is going to be up in 2024. And in the middle ground, that's what we talked about in the last video. Buying the utilities, buying the healthcare, buying the energy, and we even added to some emerging markets.
So a lot of activity. As always, there's a why. So let's go take a look at the short circuit. You know, we always like to explain why we do what we do. And if you recall, last week we explained that we were buying individual stocks because they don't always behave the way the broader markets do. This week, we are buying inverse positions. Now, I want to show you two real quick charts here so you can understand how these inverse ETFs or inverse funds work. First, you have the S&P 500 index, 500 of the largest companies in the United States. You can see the chart there. This is one of the inverse positions that we bought, SH, and you can see how it looks different. When the market goes up, the inverse funds go down and vice versa. So the idea here is we believe that we could see a larger pullback in the market over the next several weeks, and we want to protect your accounts and basically hedge so that if the market does drop further from where it is now, those funds will increase in value. And that's what we're doing for you, and that's why we're different.